Hi everyone, so today we're going to be looking at the statement of financial position, and this is also called a balance sheet because our assets must balance with our liabilities and equity. So before we begin, let's just cover a few terms. So you have current assets, which are short-term assets and which are expected to be used within 1 year. So we have cash, inventory and trade debtors, for example. We then have non-current assets, which are fixed assets, and they're expected to be used within more than 1 year. So plant and machinery is an example of this, or computers, lots of different things really. Current liabilities are liabilities you expect to repay within 1 year, and non-current liabilities are expected to be repaid within more than 1 year. So it depends on the contractual terms. Now here's an example of a balance sheet or a statement of financial position as at 31st of December 20. It's for the business we looked at in the previous lecture. Now the first part of the business balance sheet is the assets. So you have non-current first and then current. So they're organized in terms of liquidity. So trade and other, so cash is at the very bottom of current assets, and the other assets, current assets, are at the top. Below that we have liabilities. So we put the current before the non-current. Okay, and then below that we have equity, and the statement of financial position follows the formula: assets minus liabilities equals to equity. Okay. Another term for equity is net assets, and that's calculated by doing assets minus liabilities. And this figure, these two figures, have to be the same as these two figures. Okay, so our net assets must equal to total equity. Now I thought it'd be a good exercise to do some analysis of these financial statements. We have 1 year and then we have a previous year. Let's look at any unusual events. So these amounts are fairly small, I don't really care about them too much. But let's have a look at trade and other receivables. It's gone. There seems to be a massive decrease all of a sudden. It'd be interesting to see what's causing that. And we might need to use note 13 to further understand. There's been an increase in cash. We could maybe use, if there's a statement of cash flow, we could look at that and see what's going on there. I also noticed as well that there's an increase in liabilities, so our current liabilities have increased and our non-current are suddenly there. So it looks a bit unusual, and I'd probably want to do a bit more investigation into that to understand what's going on there. So I have note 14 and note 16 to use to try and get some information, if any. And also another figure we can use is net current assets, and that's the same as current assets minus current liabilities. In this case, they're both very positive. They're both in excess of 1 million, so there's no real evidence of any liquidity issues. If they're below 1, if they were negative figures, then I'd be a bit more concerned. But these are still, we're still not really sure what makes up these balances. Let's take a look at note 13. So as I said, there was a decrease during the period, but there's an increase in trade and receivables, more than the increase in revenue. So we expect trade receivables to move in line with revenue. It'd be interesting to see why that is. There might be a risk that the trade receivables is overstated in value. I also see there's a reduction in this balance. This is an intercompany balance. In this balance, we might want to understand what's causing that. And prepayments has been an increase, minor increase. So prepayments relates to prepaid subscriptions like line rental, could be magazine, rent. We have to have further breakdowns of the balances to actually come to any conclusion. So analytical review can take a bit of time to do. But generally, the reduction is caused by this reduction in this intercompany balance from 1.9 million to 1.8 million. The other balances have actually increased. Let's look at current liabilities. So Current liabilities increased during the period. Trade payables has increased, and admin expenses have also increased. Probably need to understand. I probably want further breakdowns to understand why. Other payables has increased, but what are other payables? I have no idea. From just looking at this, I can't tell. Now, the tax figure in your profit loss statement is called corporation tax. What we can also have is other tax and social security, and that's non-corporation tax, and that relates to VAT, PAYE, NIC. Now, PAYE and NIC are normally paid each month, so there's a sudden significant increase here. So it'd be interesting to see why that is. And we saw that non-current liability suddenly existed this year. It looked like there was some kind of loan, but it looks like there's some additional tax payments to make. And this is surprising because tax payments are normally made within 1 year. But under COVID-19, the government has allowed companies to defer tax payments, so this could be causing this figure here. We'd have to look at it in further detail. So just to summarize, for a statement of financial position, both sides must balance, so your assets must balance with your liabilities and equity. This is the order in which you do things: assets, then liabilities, then equity. We do non-current, then current for assets, and current, then non-current for liabilities. You always need more data than you expect, but the financial position statement is helpful because it helps you identify any liquidity issues. You can look at the cash at the end of the year compared to the beginning of the year, and also gives an indication of whether the business is sustainable in the long term. If it's highly reliant on debt, that might not be the case. It's telling you what your funding source is, i.e., is most of your money coming from liabilities or is it coming from equity? Okay, that's it for me, guys. Thanks. Cheers. Bye.